Hey everybody, are you paying too much to trade options? Well, if you're not on public.com, the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line is, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to Public and start getting rebates on every single contract traded, only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description.
Hey everybody, welcome back to Investing Unscripted, where we ask and answer and then ask again the hard questions about investing. I'm Jason Hall, joined as usual by my very good friend, the voice of the people, Jeff Santoro. Hey Jeff.
Hey, it's good to see you.
Thanks, man. It's good to be seen. It's good to see you too. It's actually been a while since we recorded everything. It might not seem like that to our listeners because you just heard last week was the episode where you and I had a conversation with Jason Moser, but that interview was actually recorded a couple of weeks before, and the one in between was one from our friends at Chit Chat Money. So
No, the one in between was a replay.
That's right. Well, it was a replay. That's right.
Yeah, we did the Chit Chat Money one when I was on vacation. See, this is the problem with the summer. You and I go away and we can't keep track of
We're saying
everything.
Chit Chat Money, it's Chit Chat Stocks now.
Yeah, hot mess all around, the two of
Yeah.
us. We got to get.
They never
we're
misname
rusty.
our podcast.
We're rusty. You didn't call it the smattering, so that's good.
That's true. That's true. Well, as far as these people know, because they haven't heard all of the takes for me to read us into the show.
That's true. Well, anyway, I'm glad that we both got our summer vacations in and that we're back. I think we should have a good little stretch here of uninterrupted podcasting. So I'm looking forward to that.
I think so. Yeah, I think so. This is going to be a fun conversation too. Yes, I'm saying that again, and I will say that a lot because we generally only have fun conversations.
Only.
But this one particularly because it's taking a little bit from some other conversations we've had over the past couple of months and also some things we've written about in the newsletter that I think is really important. And it's the idea of really fully disconnecting from investing for a period of time and how important it is or isn't, right? And I think this is going to be fun because we're not going to answer that question. We're going to ask it and maybe give our answers, like an optimal version of like our tagline. You ready for the conversation?
I am. And it's, like you said, this is building on some things we talked about in the past. We talked a little bit about it after I got back from vacation because I had some, that week away from, I was engaged in investing, which we'll dig into, but not in like the consuming the news sort of way.
Yeah.
And whereas you were just completely disconnected from all of it.
Well, I think that's a good place to start because I think that's the interesting thing is how you and I did two very different things, but really kind of for the same reason. You talked about on your vacation, you spent time reading company filings and reading Poor Charlie's Almanac, I believe you read most of. So you spent time like working on something we talk a lot about. That's two of the most important things to work on as an investor, your knowledge of the businesses that you own or that you follow and knowledge of yourself as an investor.
Yeah. And the thing that I asked you when we were chatting about this the other day was, because you just completely disconnected. And I wondered aloud if that was because for me, investing is still a fun hobby. And for you, it's your full-time job.
Yeah.
I don't go on vacation and read about, education. I use my vacation to get away from my full-time job and I do the things that I think are hobbies. It's like my hobby is your job. So it makes sense that we had different experiences. But yeah, I use it as a chance to catch up on like the learning part of investing. And so I was still disconnected in the sense that I wasn't checking my portfolio and seeing what was up and what was down and that kind of stuff. I wasn't trying to decide what to buy or if I should sell something. I wasn't doing any of that. It was literally just, let me read this and learn something. Let me read this and learn something. And I think you just completely unplugged from all of it, which you should have because it's your day job.
Well, and that's the thing. It's funny though. It's interesting because it's my day job, but it's also something that for the past nearly 15 years of my life has been pretty all-consuming. Because like you, it started off as something that I was doing on the side, and then it turned into a side gig, and then it turned into my profession, and it's been a passion along the way too. And it's true. So we'll share it with our listeners who didn't participate in our prior conversations about this. I was gone for 8 days. We flew out on a Friday afternoon. I did a little bit of work that morning, nothing on my own investing portfolio, but I did a little bit of work that's, I'm lucky that I've built my work that everything that I touch helps build my knowledge of the things that I follow or invest in or study. So that's good. And we got back. It was really the following Sunday morning. So it was a full like 8+ days that I was away. And in that 8 days, like I think I might have started to look at my Fidelity account one time and then didn't and never went back to it. I didn't read the Wall Street Journal a single time. I didn't check a single work email. I think I might have went on Slack. Somebody had a question for me about something. You and
We
I
we didn't
texted
we didn't even text much.
like maybe
You
4 or 5
disconnected from me
times.
too, which I took very personally.
Yeah, well, you should. You should, because it was intended to be personal at you. But no, and it's a couple things I think are important too that, yeah, people don't really care about my
I
vacation
was just
versus
gonna
your
say, let's get
vacation,
to the investing point. People get
but
they're gonna
there's a
leave.
point to it, and that's, your vacation, you went somewhere where people bring you cocktails and food, and you're sitting around a pool and a beach and that kind of stuff. And mine was more of a family-oriented thing. We went to spend time with family over the July 4th extended week.
Right. So I had a vacation and you didn't.
Yeah, yes, that's correct.
You just went away.
But no, there was a lot of driving involved, and there was a lot of, like, spending time with people that I see maybe once a year. A few of them maybe 2 or 3 times a year, but people that I genuinely wanted to spend time with, and you spend a lot of time with your family that you're with a lot, that everybody's off doing their own thing, right? You're sitting by the pool, you can read and you can catch up and that kind of thing. So that like like that was part of it too. But I will tell you, Jeff, and this is the important part I wanted to get to is in the past dozen plus years, I can't remember a single other vacation that I've taken, whether it was a traditional going on holiday somewhere or whether it was spending time with family, where I didn't do something like a couple of days for a couple of hours. Like a lot of times what I'll try to do because we have like trading restrictions, I'll try to time maybe investments when I'm going to be taking time because it's easier, right? Because I'm not going to be
Right.
talking about anything or
Yeah.
writing or that kind of thing. I didn't do shit, man. Like I didn't. And it was glorious.
So I'm curious because like my takeaway, it happens every time I'm too busy to pay attention to investing. And sometimes it's on vacation. Sometimes it's just I'm busy at work and a week goes by and I realize, oh, I haven't really looked at my portfolio or thought about this. I'm just too busy. I'm busy at work. I come home, I'm driving my kids places. I'm tired. I go to sleep early. It's like that kind of a vibe. And I'm always struck by it's nice to kind of just take a step back from it. Because it's a thing I like to do. It's a hobby, and but it's like a little bit of an obsession hobby too, where I spend all
Yeah.
my free time doing it. So it is nice to take a break. But getting back to like why it matters for investing, and I think the reason we wanted to have this conversation is I'm always struck by how a week can go by, or maybe even more than that, and not I didn't miss anything. I really didn't.
Right.
Like 90% of the news, it doesn't matter. 90, maybe 95, maybe 98% of the news doesn't matter. I'm not thinking about the macro economy. I'm not wondering if interest rates are going I'm just not doing any of that. And then you come back a week later or 2 weeks later and you're like, "Oh, nothing. It's fine. Everything's good. My stocks went up, or some of them did and some of them didn't, and that's cool." And it reminds me of before I got into stock investing and got sort of obsessed with it, it reminds me of the cadence of like just getting your quarterly statement in the mail for your retirement account. It's like 4 times a year I would open up the mail and I'd be like, "Oh, that must have been a bad 3 months we just went through," and then I put it in a filing thing and move on with my life, and then 3 months later, I look and I'm like, "Oh, had a better 3 and it's liberating in a way, and I think there's some value in clearing your mind and not worrying so much about everything and not trying to understand every little piece of news. So I'm curious if you have the same sort of reaction whenever you're able to get away from it.
Yeah, and focusing on this specific period of time because like I said, I certainly can't remember another time where I've gone this long and just absolutely completely disconnected. that was the big realization, and I shouldn't say realization, that was the biggest confirmation, is there are very few decisions we make that really matter, and making fewer decisions is probably better. Like, the evidence is pretty overwhelming that that's the case, and it certainly confirmed that, because essentially nothing changed in that 8 days. Of course, we didn't go into lockdown because of a pandemic. Nobody launched any nuclear weapons. There were no major things that happened during that period. And honestly, if any of those major things had have happened, it wouldn't have mattered if I had have logged into Fidelity, one morning or not. So it was definitely, that was the biggest thing, but it was confirmation, not just that you don't have to look at your portfolio every day, that you can take those extended breaks from it, but also confirming and reminding that the important work we do is often less of the things that we're doing when the market is open and we're plugged into the market, and more of the things that we're like the things that you did on your vacation are often more valuable. But the bigger thing to me, Jeff, go ahead. You wanted to say something,
No,
and I'll
go ahead.
follow up.
Finish. Go ahead.
The bigger thing to me was, and I think this is what we're going to officially title the episode, Living with the Results. It's a chance to really focus on, like, the why. Whatever you're investing for, whatever the specific things are, it's to provide economic resources to improve your life or the lives of your loved ones. If you're on vacation, you're taking time off, you're not working, you're at least dabbling your toes a little bit in whatever that future is going to be. And it's a good opportunity to kind of immerse yourself in that, right? Spending time with family. Like, my dad's not in great health. He's in his late 70s, and he had a bunch of projects that he was trying to work on, and, like, being able to be there, like, at a Monday or Tuesday morning, and being able to help him do some things was liberating, right?
Yeah,
And
I
knowing
mean,
that at some point in the future, like, being able to do those sorts of things whenever I want to, whatever those things are, it's just a reminder that, like, it's possible.
yeah, I agree with you. I think, we talk a lot about goals and incentives, and, we did a whole episode on that, and the whole idea of, like, don't let incentives in the world of investing get in the way of you achieving the reason you are investing, which is your long-term goal of retirement or whatever else you might have planned down the road.
Right.
And I had the same kind of feeling, like, when you do go on, like, a vacation or take some time away, you can not you're not so worried about the minutia and "Well, I have to do something now," and you're thinking more about, like, "Oh, this is why I'm doing all this. This is this
Yeah.
is the reason this exists." The other kind of real I've had, and it's not just vacation driven, but because I've had these little realizations along the way. So I'll give another quick example. Back in November of 2021, I think it was, I helped my dad set up a little portfolio of stocks, and talk about not great timing in terms of doing that, because everything was pretty inflated at that point. But I made a spreadsheet for him similar to the one I use, just so he could easily keep track of it, not always have to log into his brokerage and all that kind of stuff. And I haven't looked at it in, I don't know, 18 months or something like that, because it's his and not mine, and I just did it for him. And I was killing time a couple weeks ago, and I opened it up, and I was like, "Oh, wow. Like, look at this. It's doing all right." And it helped that one of the ones he picked back then was NVIDIA, but it was another realization of, like, we've joked about it before, because it turns out it's actually maybe not a true story of, like, this fictitious report that the people who do the best in investing are the people who either passed away or lost their passwords.
Right.
Um, and it was that kind of realization, like, we haven't added to this account. We haven't sold anything from it. Some of them are down 70, 80%. NVIDIA was up 800%, you
Right.
know?
Right.
Because it was just over the course of, like, I think over the course of 3 months in late 2021, we just kind of bought in thirds with some money that he had set aside to do this. And then we didn't touch it again. And, I said this to you yesterday, like, the people who should be working the hardest on our retirement are all of the people who work in the companies of the stocks we own.
Right. It's
Like, we did
yeah.
our work of buying it, and then it's sort
Yeah.
of like, all right, let's let them do the work to build our wealth. So that's just another sort of like example of this that I think taking time away can help you get clarity on.
Yeah. No, it's so true because our hardest work is like the stuff that you were doing when you were on vacation. It's like doing the deep research, understanding what you own, understanding yourself so that when you do go on vacation, you can like turn off access to your accounts and not have to worry about it for all of the reasons that we worry about it, the legitimate and the created reasons in our own head.
Yeah, and I think that's a good point too. Like, assuming you're not purposely trying to be an active trader, if you can't step away from your portfolio for a week, you're probably doing something wrong. Like if you truly are a long-term investor and you're not just trading in and out of positions, like you should be able to, honestly, you should be able to take a month off,
Right.
unless there's some huge, you know, big news with your company, which happens, but not often. So yeah, I think that was like just another the takeaway for me is just like, oh, I can leave this alone and everything will be fine. It got me thinking too, and I wanted to know your thoughts on this. We've talked about it before, but it's related to this topic, so I think it's worth talking about it again. I do still wonder sometimes if people like you and I and a lot of the listeners who are just really interested in investing, do we do too much? Do we make too many spreadsheets? Do we read too many things? Do we think too much about stuff that's sort of out of our control? Like, so here's another example. When we were just starting the podcast, it was right around the time interest rates were starting to come up. And I had never given two thoughts to interest rates other than when I wanted to get a mortgage for a house or buy a car or something. And I would be like, oh, wow, interest rates are higher or lower than the last time I tried to do this. And you had a lot of opinions on interest rates. Oh, the cost of capital is going to be higher. It's going to be harder for companies to borrow money. That's going to impact the companies that have less secure balance sheets. And that was all new to me. And now I understand it all, or at least better than I did. But I sort of wish I was still that naive person from 2.5 years ago that was like,
You know just enough to be dangerous now, right?
well, but like there was something nice. And I think in some ways, I still kind of believe this. Like there's some level of advantage you can have by not fully understanding some of these is going to sound bad. Not fully
Yeah.
understanding some of these things because I think they can get in the way.
Right.
It goes, I think we did an episode, is being a lazy investor better? And that was sort of the question I posed during that. Like, could you just buy the best, the 25 best brands in the world and then come back in 25 years and be okay? Like, I don't know,
Right.
maybe.
Yeah.
Um,
No, here, let me put a spin on that and tell me if this is kind of what you're getting at. It's having less knowledge of the things that it's not the knowledge as much as it's the ability to apply the knowledge in a way that helps create value for you. So just because you know those things, you may not know enough to actually apply it in a way to generate better returns, but you know enough to scare you out of maybe perfectly reasonable investments that are going to work out just fine over a 10 or 20-year period.
yeah. And, just a couple days ago, the podcast that we did with Dave over at Investing for Beginners came out and I listened to it. And that was one of the things we talked about. We recorded it over a month ago, so I had forgotten some of the topics. But one of the things we
Yeah.
talked about
Check
was,
out be sure to go to investingunscripted.com and find the transcript for this episode if you don't already, and I'll have the link to that podcast in it.
yeah, yeah, if you guys want to hear us as guests on the Investing for Beginners podcast, you can check that out. But that was one of the topics we talked about with Dave, the idea that he had talked about how he researched CrowdStrike for a long time and then just didn't buy it. And then it went up and he was price anchoring and he just, this whole thing. And we talked all about the mental stuff that goes along with that. And that's what made me think of this thing for today, which is like, I think he ended up, it was like paralysis by analysis for him, right? He
Yeah.
spent so much time
Yeah.
thinking about all the different things and then he psyched himself out. And then after he psyched himself out, the price went up and then he price anchored. And I'm not saying that to cast dispersions on Dave. He's a good investor. He knows what he's talking about, but
Well, and
we all do
he's
that.
also got the willingness to publicly talk about those sorts of things, and that's
Yeah.
so important.
Yep. But yeah, it's just another piece of this whole like stepping back that thing that I think is valuable is like sometimes I do think we overanalyze things and you see it on Twitter, people who knows, people post on Twitter for all different reasons. A lot of people are just engagement farming or trying to, get people to follow them. But it's an obscure chart about the last time this thing correlated with that thing. And I'm just like, I don't know, maybe just buy a great business.
Yeah. Yeah.
Yeah. Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. Want to see Netflix's average revenue per member over the past 10 years? FinChat's got it. Do you like to track YouTube's advertising? They've got that too. Want to see how much of Celsius's revenue comes from Costco? You guessed it, they've got it. The breadth of FinChat's segment and KPI data is truly one of a kind. I use FinChat all the time and I love it, especially for checking out the KPIs of all the stocks in my portfolio. To get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Well, that's the interesting thing about this, I want to call it an experiment because certainly wasn't intentional, but this process of taking this longest, really fully extended break from investing that I've taken in a very long time. I think the longest prior to this that I'd ever done was, I've talked about it on the show before. This is, oh goodness, 10 years, 12 years ago now. It's been maybe longer than that. No, this has been, I don't want to say exactly how long ago, but I'd say probably 14 years, 14 and 13, between 13 and 15 years ago, went to Europe for 17 days. And you go back that long ago, it wasn't quite as easy to get online in foreign countries as it is today. And I drove my wife absolutely batty, trying to get to, because a lot of the hotels we stayed in, they didn't have Wi-Fi back then. They didn't have internet. Like trying to find a McDonald's every day to get on their free Wi-Fi to check brokerage accounts, and it was utterly unnecessary. I wasn't trading options where, I had do anything.
But in that moment, you felt it was necessary, right? Like that was the
Totally felt, and it
yeah.
was utter horseshit that I had to. And after about 5 or 6 days, my wife kind of drew a line in the sand, and I realized that I wanted a happy, long marriage and just stopped, and things were fine. And same as this, I got back and everything was completely normal. Let's circle back around and maybe talk a little bit about how taking that time away, how we think it can be useful in different ways.
So I think for me, I still suffer from a lack of investing in patience when it comes to buying, which
Yeah.
I think is a good type of impatience to have. Like, I have my Fidelity account set up where twice a month the money comes from my checking account to my Fidelity account to be invested. And logic me says, "Oh, I'm going to let a month, maybe 2 months, maybe even 3 months of that money build up. And then I'm going to buy like a bigger chunk of like my highest conviction stock." And I never can do that. I think the most I've made it is like a whole month. So I have like, two of those transfers built up in my account and then I buy something. And typically it's like as soon as the money's there, I start looking around for what I want to spend it on, which I don't necessarily, I mean, I laugh about it. I don't necessarily think it's the worst thing in the world because I still am basically dollar cost averaging. I'm just doing it a little less frequently than I used to be. And
Right.
I
Right.
don't do it on it's not scheduled. So like there are times where I look and I can't make a decision. I just like, all right, I'm not going to buy anything today. And then maybe a week goes by and I look again. And again, I get busy and I just can't do it for several days. And I've noticed that if I do take time away because I'm on vacation or because it's busy, I that cash accumulates and then I am able to buy a bigger chunk of something when I do make a decision. So for me, it's like we talk about friction a lot. It's like it's an easy way for me to build up some cash so that I'm not buying as tiny little slices of
Mhm.
everything. So that's one place that I think it helps me. What about you? Is there a specific way in which it benefits you?
Yeah. So I've talked a little bit about how it reinforced a lot of things that I, intellectually already knew. But when you see it happen or not happen, in this case, right, my portfolio didn't lose 20% of its value because I wasn't there to log in every day. It's just a reminder of what's important, both in the portfolio, but also what's important in the why we do it anyway part, just again reinforcing that. But one thing that it also kind of let me do is step back and kind of after the fact think about my whole process and the strategy that I've taken and the investments that I've made, and really think, is it still working properly? Is there anything about my financial goals or where I am in life, the age of my kid, my wife and I thinking about our long-term financial goals, short-term financial goals, like saving for college, saving for retirement, vacation home, leaving a legacy, like all of those things. Is it time for the strategy to change, right? Is it time to start thinking more about fixed income? Do I need to own more real estate for yield? Like all of those things, thinking through all of that. When you take an extended break away from kind of being right in the middle of it, it's a lot easier to think strategically. There's the saying, no battle plan survives first contact with the enemy. And the reality is that when you're with any endeavor, when you're in the middle of doing it, you're going to be so focused on the tactical decisions that you're making. Okay, what do I do next? Okay, what do I do next? Okay, this happened. How do I adjust? That you can't be strategic. You have to remove yourself and sit back and see the bigger picture and reevaluate. And it's been a nice opportunity to do that, because here I am, we're recording this. It's day 2 of being back. And I've done some work stuff. Jeff, I still haven't logged into my portfolio.
Yeah. I can't say that I lasted that long after I got back. But, what you said made me think of something. So I'm pretty sure that there is actual research that backs this up, although I can't tell you if that's true because I just thought of this right now. But I remember reading or hearing that there's some research that shows that boredom is really good for your brain.
It's
And,
true.
the act of just being like, intellectually disengaged. So like it happens a lot when people are running or showering or like gardening, where you're just doing like, I don't want to say mindless work, but nothing that's like mentally intensive.
Right.
And that's when a lot of creative ideas just pop into your head. And I've
Yeah.
noticed it not so much with investing, edit.
Well,
And
in
I've
your
noticed,
in your in your professional line of work, there's actually been a lot of research that's been done with kids around this
yeah,
particular thing.
yeah, but I've noticed it with not so much with investing, but honestly with ideas for the podcast.
Yeah.
Like sometimes
Yeah.
I will be doing, I'll be cutting the grass or I'll be running or just something where like my mind is not on anything. It's just sort of wandering. And all of a sudden it's like, oh wow, that's a cool idea, you know? And
We have our go ahead. Go ahead.
I was gonna say, I did have some similar experiences when I was away about a month ago where, and you said it good, like or said it well, when you're not in the day to day, when you're not like in the middle of it, you can have those higher level sort of random thoughts. So there were times when I would think like, you know, oh, maybe I should just think less about exactly what I buy each time and just buy the thing that like I come to quickly because I'm still buying such tiny amounts that I'm basically dollar cost averaging anyway. Like, why am I spending so much time thinking about it? Right. That's just like this high level idea that I had that just came to me, whatever. I was staring at a pool or something.
Right.
Um, so I think I
Well
agree with you on that. Like, getting your head back into the cloud, so to speak, can help you, maybe see the field of play a little bit clearer.
it's a running joke between you and I, my thinking time, where
Wait, when the rest of us are working, Jason's
yeah, no,
thinking.
it's true, and it's funny because it's kind of the nature of the work that I do. I do need to spend time kind of in abstract thought and just processing things, and also just the way that I'm wired. I've worked from home since 2011 or 12 full time, and most of the 7 or 8 years before that, I was in outside sales working out of my home office most of the time. So, like, I've always had these blocks of time at home where I would try to have other things to do. Like, I've always kept the garden, so I'd go tend the garden. I've done a lot of woodworking projects, and I would try to build in these little parts of my day where I'd have 20 or 30 minutes to go do a relatively mindless task where I'd be present doing it, but I could also just kind of let my mind process other things. And I found that when I've prioritized making that time in my just regular daily life, I'm far more productive on the other stuff. And also I tend to be more creative. It 100% supports exactly what you're talking about. And everybody can't do that, right? You're during your regular work time, it's very challenging. I know you've talked about for you to create that space. You got 2 kids at home, a wife with a full-time job. It's just creating that space is very, very difficult for most people. So I'm pretty lucky in that regard. And building in those blocks of time away, even if it's once or twice a year, to let yourself kind of think more strategically, I think is really, really important.
All right. So I think this is to quote our friends at the Odd Lots podcast. I think we can leave it here for now because this wasn't meant to be that long of a discussion. I think we kind of hit everything we wanted to talk about. But it was funny. We both had the same sort of thought after our vacation, so we figured we'd have a little impromptu conversation about it on the podcast here for our listeners. But don't go away. This is not going to be a 30-minute podcast. After our short break here, we're going to do our Q2 portfolio contest review. So stick around for that.
Hey, everybody, we'll be right back, but first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carries significant risk. Full disclosures and podcast description. U.S. members only.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and level up your investing skills today.
Hey, everybody. Welcome back from that little break. For our YouTube visitors, yes, I did a wardrobe change. Actually, I did a whole day change, Jeff. We're taping this about 24 hours after we taped the first part of the show. Now, you, of course, planned for that.
Yeah, I'm wearing the exact same shirt, and it's not because I don't change my clothes. It's because I don't change my clothes. All right, let's move
Never
on.
change, Jeff Santoro. Never change.
So we're going to talk about the portfolio contest. We decided not to devote an entire episode to the quarter two results, but I'm sorry, the second quarter results. But we're going to do a conversation here about it. And so let's just get the information out right at the top here. The Q2 winner and the person whose charity we will be donating to was once again stand-up comedian Mitch Fatel. Now, Jason, I think this might be the last quarter that Mitch wins because one of his biggest winners, Shockwave Medical, is no longer a publicly traded company. So it is now capped. It'll be a 0% gainer for the rest of the year.
It's locked in at 75.7% for the year.
Yeah, he's locked in.
Yeah.
So I don't know. We'll see. But just for variety's sake, I mean, I like Mitch, great guy. But for variety's sake, I'm hoping we get some new winners in here. But yes, his portfolio was up an average of 28%. Remember, it's just for the quarter. It's not beginning of the year
April,
to the
May,
end of
June.
Q2. It's just those 3 months. And it really wasn't close. I think the second best performing portfolio, other than the 2-stock portfolio that we don't count, was our listener Colin. His portfolio was up an average of 12%. And then Nick and Casey Rossalillo, they were up 10%. Everyone else was below zero or below the S&P anyway. So not a great quarter for most of the participants.
Yeah, I'm glad you mentioned that because that's like one of the things that sticks out. So first of all, and we'll talk more about this, it's still incredibly short term. We're talking about 90 days of results. Yeah, picking good companies is important, right? When you're picking stocks, but there's a lot of luck in just timing things that we don't control, right? In these short periods of time. So,
but yes, and I think it's important we keep saying that, but I also think it's important that we talk about the fact that it's short term because I think people think quarter to quarter. Most investors do. I mean,
that's
I
the
know
whole
I
news
do
cycle is built around the quarter.
Yeah, but also that's when you get news.
Right.
Like, so the next time I'm going to be thinking about the companies in my portfolio deeply will be in the next several weeks as we get earnings results.
Yeah.
So, the month to month is just fun to talk about silly stuff. But I think in a quarter, you can get some signal through the noise in terms of why the stock did what it did in that particular 3-month span. So, but yes, it is not, I'm not ready to crown Mitch Fatel the next world's best investor after 2 good quarters, but credit where credit's due. It is a 1-year game.
Yeah, no, that's exactly right. It was interesting too, just to take it kind of the next part of that is beating the market can be really damn hard. I can't remember the exact number. It's either 11 or 12. I did the math yesterday and I'm not going to do it again. But it's either 11 or 12 portfolios that are people that like work full time in investing in some fashion, right? So call us the professionals. I'm even putting you in that, Jeff, even though, you consider yourself an avid amateur. But I mean, you have a podcast. So
I guess that makes me something.
so far year to date, only 3 of that group have outperformed the S&P.
All right. So I'm glad you said that because this is a question I want to ask you that's tangentially related to the portfolio contest. So where do you fall on this line of thinking? I heard someone say recently that comparing yourself to the S&P 500 is, I don't want to say wrong or a bad comparison or something like that, but it's worth thinking about because so much of the S&P 500 is dominated by the biggest companies in the world.
Right.
And the basic point is unless you own NVIDIA or Apple or Microsoft or one of those top 6, top 7 companies, it's almost impossible to beat the S&P 500.
Yeah, it's very difficult
because they pull so much of that weight.
Yeah. Yeah.
So I'm not saying we should cut ourselves some slack, but should we cut ourselves some slack, Jason?
Yes, because it's the short term. Yes, because it's short term, but not because we're not beating the market. Because hard or not, if you're picking individual stocks, you should benchmark yourself against the easiest way to get large exposure to the stock market. And that's S&P 500 index funds, right? So that's it. Now, for a contest like this, there's a caveat there though. And I've talked about this before. And there was some stuff going on around about hedge funds underperforming the market. I think because like all the Q2 data starts coming out, right? So the thing is like something like a hedge fund, they may not be benchmarking against the S&P. Even every equity investor might not be trying to beat the S&P 500. So, and I'll use the hedge funds as an example. They hedge because they're trying to limit losses too, right? They're trying to create exposure to the market broadly and get gains, but also limit losses in a lot of cases, right? So they want to beat the S&P when the S&P is struggling or the market's down. They want to do well in all markets, right? And that's a very different thing than owning stocks and accepting the fact that the market can fall sharply in a short period of time. But if you're investing for the long term, you're going to get really, really good returns. If you're trying to protect against losses too, your strategy can be different. Also, if you're investing for income, honestly, until the past year and a half, most of the past 2 decades has not been a great place to get yield. Interest rates have been generally low. They were higher coming into the financial crisis, and then they slashed them, and they stayed low for most of the 2010s, right? They started coming up in 2019. Fed started raising rates again, then the pandemic happened. They gutted them again, right? Now we're way, way up where we haven't been in 3 decades. The point is, like one of the things I've talked about before is Coca-Cola. Since 94, when Berkshire completed its investment, bought its couple $1 billion worth total, whatever the cost basis is, it's like absolutely been killed by the S&P 500. Like it's not even close. Like the S&P 500 has done like 900% better. But Coca-Cola has generated 8% in average total returns, and a lot of that is dividends and dividend growth. And that's a hell of a lot better than you would have gotten in treasuries over that period of time. And Coca-Cola is one of the very safest companies in the world to own, right? So maybe you're not expecting to outperform the S&P. Maybe you're even hoping for about market level returns, but it's a very safe investment that's going to do better than fixed income investments like bonds, right? So there's that in the middle stuff that investors have to think about too. So, but for our contest, yeah, we should absolutely be made fun of for underperforming the S&P 500.
All right, so let's play some hindsight bias here, right? You now know how your portfolio has done over the first half of the year, right? So just to recap for the listeners, year to date, your portfolio is down 31%. Mine is down around 9% as of the day we're recording this.
Right.
So and in Q2, we had returns of your portfolio average, let's see,
It's down like
down 3%
which
for
felt like
the
a gain.
quarter.
I mean, it did.
Yeah, honestly, we're from where you started, yes. And mine averaged down 1%. So I'm curious if you could swap out right now, mid-year, if we allowed mid-year changes, which we don't, it's against the constitution of our portfolio contest. But if you could swap something out or multiple things out of your portfolio and replace them with something else, what would you swap out and what would you replace it with?
STEM and TPI Composites. I would swap those out. STEM may go bankrupt. I don't want to say management's lied to us, but I think they've been wildly over optimistic about their ability to collect on some of these to close business. I shouldn't say collect, to close business, and their balance sheet's a mess. They made that big also energy acquisition, which I thought was a good deal. It was getting like some solar exposure, but they blew up their balance sheet to do it, and it could backfire. And then TPI Composites, the thesis is, I don't want to say it's broken, but part of the thesis had been like their composites that they do for blades for these giant wind turbines. That same expertise, they've been using it for chassis for electric vehicles, like delivery vans and stuff like that. They're selling that business because the EV business has gone into, a big downturn. So like, I feel like the thesis for those two is pretty broken. What would I replace them with is hard to say. I mean, I might be willing to like double down on SoFi as a starting point. Boston Omaha is another one that I would really seriously consider pulling out. And I'd replace it with something like Brookfield Infrastructure.
Yeah, I think I'm looking through mine and I'm thinking to myself, forgetting the returns, which ones had business results that troubled me? Progeny had a bad quarter, but I don't know that it's indicative of a thesis being broken. I mean, companies have bad quarters, right? So I'm in a wait and see mode with that stock. I think looking at my picks, I would have to be honest and say the one that is the closest to being a busted thesis is Boston Omaha, like you just said.
Yeah.
There's just been so much change over the last couple months with that company. I haven't sold it yet. I don't know that I would want to. I still think I'm willing to give them a couple quarters to see if this new situation with one CEO and everything can actually result in better financial results. We'll see.
Yeah.
I think if I was going to get rid of one that wasn't Boston Omaha, I would swap out Health Peak Properties, not because it's not done well. I just don't care about it. I said at the beginning of the year, I chose it because I thought it would make me like follow it closer and pay more attention and learn more about it. And I have tried to, and it does not interest me. I guess I bought it because I wanted REIT exposure, and it was one that I thought was a unique niche within the world of REITs, right? They do medical facilities and outpatient and outpatient facilities and labs and things like that. But it just kind of bores me. There's some returns I'm not thrilled about. Like after being up 23% in the first quarter, Dreamfinder Homes was down 41% in the second quarter. But I don't think there's anything wrong with the business. I wouldn't swap it out because of just the returns.
That brings up a question. What stocks would you buy more of right now?
Of the ones that are in there?
Yeah.
So based on business performance, but not valuation, CrowdStrike.
Yeah.
CrowdStrike's by far my highest conviction holding.
In your portfolio or of your actual personal investment?
Of everything I own.
Okay. Yeah.
But in this portfolio too. It's just right now, like it's very, very expensive in my opinion. So I don't know that I would add to it. And I also feel like because it is a tech stock, there's a decent chance whenever we do have a big market downturn, it will go with it and I can buy more then. But from a performance standpoint, I mean, every quarter I'm just like, man, this company's great. So I double down on that. If I could sort of eliminate valuation from the consideration. Now, if I can't do that, I would add more to either EPR Properties,
Yeah,
or PayPal. And
interesting.
EPR because we've talked about this one before, but I just feel like I like that they're a REIT also, and they lease land to entertainment-oriented properties, experiential properties, like they own all the Topgolf, the land that all the Topgolfs are on.
Yeah, I think
Um,
Topgolf is their biggest non-theater tenant.
right.
Then
So they
Vail's a
have a
big
lot of
one.
theater exposure, but that's decreasing over time,
Yeah,
so
yeah,
cool.
yeah.
I'm very interested to see. I like PayPal's new management team. I like the new CEO. I like he's made some changes right off the bat to like what they report and how they report it to be more transparent. Seems like they're more focused. My theory of own good brands and you'll probably be okay is driving my thinking on PayPal. I mean, I PayPal and Venmo are the only ways I send money to other people. Sometimes Zelle, if it's an older person, if I'm being honest, because that's like every bank has Zelle kind of a thing.
Yeah.
But yeah, I'm very curious to see how Q3 and Q4 are for PayPal. What about you? What would you double down on? I mean, you mentioned SoFi, but any others?
Yeah, I've been thinking about this. I talked about on the main part of our show how I really haven't looked at very much for going on 10 or 11 days at this point. But I do think like the Brookfield Renewables, Brookfield Infrastructure, a lot of those companies, the stocks have really come down because there's worries about interest rates and cost of capital because they use a lot of debt to fund their projects and that sort of thing. But I just think the market's missing it. I would also think about, and the risk of it is if we do go into recession, it's not good for banks, but I would think about maybe replacing STEM and TPI with another bank like Axos Financial or maybe Live Oak Bank or something like that. Just ones that trade for really good valuations and they execute well. They're just really good at their businesses. Instead of these bottom feeding that I was doing, trying to catch the cycle turn on renewables. So that's probably what I would think about doing.
All right. Whose portfolio in the contest would you, if you could swap yours for someone else's and then take theirs for the rest of the contest, for the rest of the year, whose would you take? I'm taking Mitch Patel.
That's funny. That's funny. Maybe one of the chit chat stocks portfolios.
Ryan or Brett, yeah.
Yeah, maybe also I'd think about Lou's portfolio. Like Walmart, for example. If the economy doesn't go good, that stock's probably going to do well. I think Starbucks management's doing the right things to get that business turned around. I think it's going to have a really good second half of the year. There's a number of stocks in there that I think are really interesting.
I think for the rest of the year, I'd go with Nick and Casey's portfolio. I think going all in on semiconductor stocks this year was probably a smart move, unless it turns out that, December was the top of the hype cycle for a lot of them and maybe it cools off for the rest of this year. I'd probably pick them. All right, here's another one. And maybe this will be our wrap-up question. If you could pick someone else's portfolio from the contest, and you'd have to hold those stocks in your portfolio for the rest of your life, what would you go with?
That's really hard.
You have to, yeah. I mean, in addition to the stocks you already have, but whose portfolio would you take for the rest of your life? And this is also not a fair question because I don't think people chose stocks necessarily for the long term.
No. So this is really hard. There were really three that I thought were really interesting. Like Craig's is pretty interesting. Alexander Real Estate's a really good business. Endava is a really good business. Spotify. I think Upstart's unappreciated. I really think they're going to figure this out once the lending cycle gets healthy again. I thought Lance's was interesting, even though
All right, come on, pick one. You're
never wanna
stalling.
I never want to own Smith and Wesson though. Just the gun industry is a terrible. They usually go bankrupt. Those businesses don't do really well. But I landed on Collins. There's some interesting things there. There's some businesses that I think are going to be super durable, like TSMC, Taiwan Semi. Invitation Homes I don't own, so it would be a great way to add that business. Polaris Renewable is one that I've started to follow a little bit. And even though I've said I'd never own a tobacco company, if I would, British American's probably the one that I would. It's always cheap and always pays a good yield, and they grow the dividend. So what about you?
Okay. Based on my respect for the level of research and thought that they put into their stocks, I would actually go with either Tyler's or Jim Gillies. Tyler's portfolio is sneaky, like sneakily doing well.
Yeah.
Right. First quarter up average of 11%, second quarter up average of 10%. So like basically a market matching performance over the first 2 quarters. I can't say I would take it for the rest of my life though, because I don't know enough of those companies. Same thing with
Yeah.
Jim Gillies. I have a lot of respect for Jim. I don't know that he chose this portfolio for like a long-term focus, but from a respect the analyst stock picker perspective, I would also go with Jim Gillies. But the one I would pick based on my knowledge of the companies in it is actually Jamie's.
Okay.
So Jamie's got
Yeah.
Airbnb, Booking Holdings, Celsius, Starbucks, Taiwan Semi. So
Yeah.
basically, if people are going to travel and drink addictive beverages, and if semiconductors are going to be a thing, that portfolio should do fine for the rest of my life.
Yeah, no, it's definitely got some really good potential staying power, some really powerful brands there. That's for sure. Yeah. Here's the thing. So Tyler, I'll say this. So Tyler and Jim Gillies, probably the two most disciplined stock pickers in this group in terms of like when they pick these stocks, they did it because the valuation made sense. Right.
Right.
There's no doubt about it for all of those companies that they pick. Also, they will walk away from a company without even thinking twice. If they think the thesis is broken, the valuation has gotten out of range, or some other reason, they are disciplined, value-focused investors. So yeah, I agree that you like your thoughts about neither of them being thought of as own forever portfolios. They don't think about own forever. Own as
Yeah.
long as it makes sense. Right. So
That's a good point.
Yeah.
All right. So to wrap up, Mitch Fatel is our Q2 winner. His charity is the Wounded Warrior Project. So as we did at the end of Q1, Jason and I will be donating money to the Wounded Warrior Project because that was the whole reason we did this portfolio contest to begin with, was to help out some charities. So if you're listening to this and you are so inclined and financially able to also support the Wounded Warrior Project, play along with us, give them some money, and help us make this portfolio contest something a little bit more fun than just busting on Jason for having the worst portfolio. And we'll be back at the end of the next quarter to see who won that one.
So it's the worst portfolio by far.
Mm-hmm.
So far.
Not even close.
So far. Yeah.
Oh, look at you.
Also not even close. No, it can get worse. It can get
It
worse.
can get worse, but it could get better. Let's stay positive for you. It won't. All right. Why don't you wrap us up here, Jason? I think we've said it all.
We're done. We have done it all we have. As always, we love to share our thoughts and give our answers to these hard investing questions out there. Of course, it is still, dear listeners, it is up to you to find your answers to those questions. You can do it. I believe in you. All right, Jeff. We'll see you next time.
See you next time.